Hello everyone and welcome to the Q2 Construction Insurance Power Panel here on Insurance Business TV. Yes, this is where we take our quarterly look at the state of the market with some of the industry's top executives. And it will be no surprise that tariffs are high on today's agenda. So let's meet our experts. This time we welcome Natalie Kenny, SVP, Senior Placement Specialist, North American Builders Risk Broking Team at WTW. And Megan Remley, SVP and Team Leader of the Construction and Design Practice at Lockton. So welcome both, and as I said at the top, tariffs will be a keen focus today. So how have recent tariffs on imported construction materials affected project costs, and indeed, how are those increases translating into shifts in insurance valuations and premiums? Megan, I'll start with you.
Thank you. So far, we really haven't seen any impacts on ongoing construction projects. Those seem to be moving along without much impact from the tariffs. But what we are seeing is a shift in thought process on upcoming projects that have yet to go. Are those still going? We're seeing some get put on the shelf and go on hold. So no impact quite yet on valuations and premiums on existing projects, but it's more speculative about new construction and what the tariff impact will be on the cost of it go forward.
Okay, so perhaps no direct impact just yet, Natalie. And I guess we have to remember as well that it was a softer market going into 2025 as well.
Yes, you're right. Heading into 2025, we were experiencing an influx of insurance capacity in the builder's risk and property market. It was setting up to be a significant capacity year, predictions of a softer market due to capacity availability, lofty budgets, goals for all the markets kicking off 2025. New entries into the market, MGAs, facility offerings, increasing appetite, and the market carriers expanding. So with that, the effect to the insurance industry with the introduction of tariffs and the talk of economic uncertainty could affecting the supply chains and market direction. We have seen a significant slowdown in the project starts. Just as Megan said, that'll have continue to have a direct impact to the insurance industry. Noting a lot of the large scale projects that we were expecting for Q1, Q2 have paused for redesign or indefinitely due to uncertainty around the budget pricing. Clients have had to make adjustments, and insurance carriers will have to do the same to ensure they're managing their capacity and opportunities for the coming year, setting up for Q3, Q4, and into 2026.
So clients are having to make adjustments, as you said there, Natalie. But what strategies should brokers use to help clients mitigate those insurance cost increases that are going to be driven by those tariff-inflated material prices?
So builders risk policies are typically written on a completed value basis to the full value of the project budget, based on an estimate that you use or we use as brokers at the start of the construction term. For brokers and insurance companies, there's been a long time assumed volatility around budget changes during the construction term, either due to inflation costs, material shortage, or budget changes, change orders, simple change orders. Focus for brokers and clients is to ensure the policies are flexible enough to account for those fluctuations in budgets, due to economic and tariff changes, as well as we'll start to see, or as I said, just simply some of change orders. Considerations that we as brokers will look to utilize within the policies are a couple of things. One being escalation clauses. Those are triggers within the builder's risk to automatically increase the insurance coverage, to account for changes in overall budget. That can be somewhere in between 5 to 10% written into the policy forms at the project inception. And it allows for, it's particularly significant, because it allows for those unexpected costs related to the market fluctuations. The other strategy is budget contingencies, and we're seeing our clients, contractors and owners alike, increase those budget contingencies that they work into the budgets at the onset, to ensure that there is flexibility to manage any market fluctuations as they come up during the policy term from the outset.
I guess a further strategy as well, Megan, it might be stating the obvious, but you've got to make sure those contracts are structured correctly.
Absolutely. Yeah, that's where it all starts, is just making sure that from the top down, all parties ideally um, understand and are mutually agreeable to what's going to happen should the costs increase. And that, certainly whoever is purchasing the builder's risk, whether it's the owner or the contractor, understands that implication of increased costs equals generally, if we exceed what Natalie referred to earlier in the escalation provision, that there will be increased premiums, and we need to capture that and report those, increased costs to the carriers. So, yeah, it just starts at the very beginning with getting that contract structured correctly and then communicating to all parties so that they understand how things will happen throughout the course of the project.
I appreciate that it's early days as well, Megan, but are you seeing any changes in underwriting behavior or appetite from insurers as a direct result of these tariffs affecting material supply chains and indeed project timelines as well?
Not quite yet. They're not as a direct result because again, I think it's early on. But I do believe that the construction community and the underwriting community learned a lot during COVID and will be prepared and ready to address any potential increase in cost and delays, et cetera, that may occur as a direct result of these tariffs in the future.
Is that something you agree with as well, Natalie, that clients are perhaps more prepared thanks to COVID?
Yeah, I do think they are, and just as Megan said, for our clients, I've noticed that clients have a bit more of a proactive approach in addressing underwriting questions that have come up, specifically around the heightened review, engineering review process that we might find underwriters looking at for those materials within construction that have long lead times. Clients are tackling that question about material sourcing and equipment sourcing in the forefront of either pivoting from another project, the ability to shift materials from one project to a next if there's a delay or a loss that they can use or grab from another project, or potentially they're buying materials early, much earlier on in the process and storing them off-site. We were getting a lot of questions from underwriters on around offsite storage and what that exposure increase might be associated with a particular project, especially when we're talking about those large scale billion plus projects. In the past, we may have seen offsite storage limits of 10, 15 million max. Those are certainly the need for coverage to cover materials as they come to the site earlier or come to an offsite location earlier, are growing, and there is some underwriting discussion of what do those look like? How do we price that into our policies? Other than that, I agree with Megan. I think it's a little early to tell. Underwriters are not as focused on tariff related underwriting changes, but that could change in the future, and we'll be prepared. And I think clients are prepared for that, just given their experience with the post-COVID environment.
And Megan, how is that price volatility, that supply chain uncertainty that might be prompted by the tariffs, how's that affecting the accuracy of replacement cost estimates in property and builders risk policies?
Everybody wants to have proper insurance. I mean, I think that's most people's goal on a project, is to have adequate protection. So, brokers, contractors, owners alike are doing their best to estimate costs. Um, as Natalie said in a previous question, those large pieces of equipment with long lead time tend to be, they're the most expensive anyway. So I think there's a particular focus on those materials and the cost implication of that as opposed to the typical construction materials that can be procured domestically and on shorter lead times. But at this point, it's conservatively estimating so that we aren't finding ourselves in an underinsured position and doing our best up front.
Is that something you're seeing with builders risk policies as well, Natalie?
Yeah, absolutely. And we've been talking a lot about builders risk policies as we go forward. But there should be some, viewpoint of inforce policies and the replacement cost values associated with the budgets that we used, 1, 2 years ago to put in place builders risk coverage for inforce builders risk projects. There should be some revisit or at least some discussion with clients around those replacement costs. Should there be a claim or a loss that incurs now and they're having to, get new materials in to replace anything that's damaged, there could be an influx of or an increase to the replacement cost that wasn't contemplated at the original placement time, and further to that, looking at our cat limits. When we put these builders risk policies in place, we do analysis around probable maximum loss associated with cat limits for the budget that we put the policy in place for originally. So is there some underinsurance associated with named windstorm or earthquake or flood that we should be talking with our clients with for inforce policies now versus waiting to see post loss if there's enough coverage or enough coverage to cover them for the those particular cat limits. So certainly, I think there's discussion that should be having or should be ongoing with our clients for those inforce builders risk policies that we put in place a year or maybe 2 years ago.
Well, let me pick up on that point about those ongoing discussions with clients with you, Megan, as well. I mean, to what extent do you think that clients are aware of the insurance implications of tariffs? And indeed, what conversations are you having with them to help manage those expectations and their planning?
I think it's the broker's responsibility to help their client become aware. It's, they're focused on building a successful project, whether it's, the owner or the contractor, that is their focus here. And so we as brokers really need to do a good job of helping our clients to understand what this could mean for them. It was mentioned previously, you have existing policies that you may need to look at those and say, hey, if this project, something, catastrophic happened today, is this valuation correct? And do we need to make an adjustment midterm and talk to the underwriter? And similarly, go forward, that conversation is just making sure that we all understand the impact on cost that these tariffs could have, especially when it comes to premium and how the policies are written and what you actually get at the time of a claim if you haven't reported adequate values. So that's just an upfront proactive conversation that we brokers need to be having now, right? On builder's risk, we're placing those every single day. So it's not a wait until renewal, it's talk now. For those with large portfolios of, property, that most certainly needs to be considered both midterm and at renewal. Is am I properly valued? Because at the end of the day, you're buying this insurance to protect the business. And if it doesn't do that for you, that's a loss. So we want to make sure that you're getting what you're paying for.
Yeah, those upfront conversations are vital, aren't they, Natalie? But at the same time, perhaps they're a little bit easier because those tariffs are all over the headlines, and therefore perhaps clients are a little bit more prepared.
Yeah, I think clients are very aware of the impact and implication of tariffs. I mean, we certainly are seeing our clients proactively having this conversation with us versus in the past, maybe from a broker perspective, we were bringing it up to them. I think they're better prepared, just based off of the implications coming off the supply chain disruptions that we saw post-COVID shutdowns for what could happen from a price shift or swing on materials, and overall cost implications to their budgets. And then further, as Megan said, preparing for what that means for insurance premiums in general, right? Just because the increase of the values and how builders risk is ultimately priced, as those values go up, so does the insurance premium. And while we talk about a softer market, there's only so much of a softer market we can do to account for those increased in material costs. So I agree that the clients are prepared. They are having proactive conversations, which is great to see. And then, obviously, just to make sure that they are prepared and able to financially, assess the viability of these projects going forward.
And just one final question to throw at you, Natalie, if I can. Have you seen increased claims or disputes related to these tariff-driven project delays or cost escalations? And indeed, if you have, how are they being handled from both a coverage and a claims management perspective?
I think it's still too early to tell the true claims effects for these new tariff-specific project delays or escalations. That said, we have seen inflationary issues in the past, notably in the frame construction space post COVID shutdowns, where material costs for lumber had spiked, and we found projects that had losses or incurred losses late into the project term, incurred significantly undervalued or realized significantly undervalued coverage post loss. And the effect of that lack of midterm review and adjustment to the policy limit as a result of those cost overruns. So I just continue to stress that consistent review of, especially for those larger projects, construction budgets, midterm, that continues to be crucial to ensure the escalation extensions and the contingencies that are built into these policy forms meets the needs of the changing construction pricing environment, including change order scope changes, et cetera. The escalation benefit allows flexibility within the project contingency and affords the client some coverage for those unforeseen and undocumented changes. And we as brokers and clients really just should ensure or have a touch point to make sure that we are put forward the coverage properly.
Would you agree overall then, Megan, that it's perhaps a little bit too early to tell on some of these things?
I think so. Yeah, I do agree with that. And as I think about it, we're just continue to talk about cost increase, right? And at the most basic level, I think that the best insurance can be in place here, but what owners and contractors need to be thinking about is the budget and the ability to afford this project. And if the contractor is working for an owner who there's concern over the ability to get paid and to handle these potential costs increase related to tariffs, then that's probably the first place to start is, really underwriting that financial aspect of the project. If you have a critical stake in it, you need to make sure that A, if you're the owner, you can really afford to pay for this and pay the contractors, because unpaid contractors don't generally build great projects. So if you can afford to pay everybody, even if the costs increase, then that will likely still be a successful project. But if that ability to pay and get paid becomes impeded related to these tariffs, I think that's when everything starts to break down and leads to claims, insurance claims, and uninsured claims on projects.
There you go. A fantastic update on the state of the market. Huge thanks to both Natalie and Megan for their debut contributions. Clearly, a lot of these issues are just emerging, so there will be plenty to discuss in the future related to tariffs and more. So keep it right here on Insurance Business TV.